So with that, we'll get started with the lecture for today. So since we have lecture 2 days a week, we'll get through about half of the chapter 1 slides today. And however far we get, then we'll begin there next lecture. So chapter 1 is an introduction to accounting and business. And we're going to go over the nature of business and the role of accounting and ethics in business, and the generally accepted accounting principles, which are the baseline for all financial accounting, and it's the standards that say, how do you record all of these individual transactions? Everybody in the US uses them, and that's how everything gets standardized. The accounting equation and every element in the accounting equation, which is the structure for how accounting transactions are also, all of these objectives are baseline assumptions that are necessary for understanding how does accounting work and how do you actually record these transactions. And then we'll be going through a number of transactions individually and how they impact the different sides of the accounting equation, which will lead into next week's lectures on debits and credits, which is how transactions are recorded, and journal entries. And then we're going to describe the financial statements of a proprietorship, which is a business owned by a single person, and how they interrelate. That's balance sheet, income statement, statement of cash flows, and the statement of owner's equity. And these are the statements that we give to business owners to understand how much money do they have, how much money have they made, where is the money going, that kind of thing. And that is really all that financial accounting is creating those financial statements to share with end users. And then we'll also take a look at the ratio of liabilities to owner's equity in evaluating a company's financial condition. So that's then the other part of financial accounting, is taking those financial statements and saying, how do we interpret this? What does this actually mean about a business? The nature of business and accounting: business gets resources such as investments from an owner, wages, like work or wages from employees, labor, materials, assembles it into goods or services, and gives it to users. And the profit is the difference between revenues and expenses. The goal of a business is to make a profit, as well as other goals of the business owner. For example, engaging sustainably in the community. However, the financial objective is profit. And yeah, so an important definition for the difference between the amount paid and the amount provided by the business, the amount that is generated for the owners, is the profit. There's 3 types of businesses: service, retail, and manufacturing. I think there's maybe 1 or 2 homework problems just identifying the different types of businesses. This is important for accounting because in accounting, we're recording business activities. Different types of businesses will have different types of activities. So service businesses, usually the input is labor, salaries, that kind of thing. And you're providing a service to customers. Sometimes the customers pay in advance. For example, a software company, they pay in advance for the whole year, but you haven't actually earned that revenue as a business. For example, if you prepay for a year of Xbox Live, right? Xbox or Microsoft hasn't earned that money until you've used it up slowly throughout the year. So in quarter 1, they're going to report a quarter of the revenue from Xbox Live that you paid for the entire year. And then quarter two, they're going to record another quarter. By the end of the year, they're going to have recorded that entire thing. So that, that's an example of how that would impact the accounting cycle for a service business. Retail, they're purchasing inventory, generally. That's going to be the majority of the expenses. Inventory, and then selling that inventory, which the expense would be cost of goods sold. The revenue would be retail revenue or revenue from sales or things like that. So there's different, and then manufacturing, you're purchasing the raw materials, you have the expense to run the factory, and then the revenue from selling all the goods that you're making. And these are very different cycles. So there's different journal entries, different kinds of things that'll come from that. It's more just baseline information. Anyways, does anyone have any questions about that? Right. So which of the following businesses would be considered a service business? Southwest, great. And what about oh yeah, okay. And then Walmart, got it. And then Ford Motor Company, yep. And then Starbucks, it seems retail or I don't actually know what Starbucks would be. Some of these, it can get kind of a gray area sometimes, right? I think Starbucks would be probably service. Yeah, I think the main expense would be the employees, the baristas. Also, in case you were wondering, today is pumpkin spice latte day. It's fall. Summer's officially over.
That whatever the company's biggest expense would be how we categorize them?
Generally, yeah.
Okay.
And in the homework, they use pretty obvious examples. And they don't actually use specific companies. They say a company does this thing. What kind of a business is it? And also the homework, you get unlimited attempts and you can say check your work during the answers. So it's more just like homework in this class is honestly the most important way to learn. And it's just going through it and spending the time to fill out all the boxes and work through the exercises, which isn't as relevant for this kind of thing. This will only show up in the first chapter, and in the future, the accounting equation is the most important thing for you guys to focus on this chapter, and we'll get into that soon. Business activities. There's three kinds of business activities: financing, operating, and investing. Operating is going to be the majority of activities in a business. You think the day-to-day. So for Southwest, operating activities would be buying gas for their planes, paying the pilots, paying the flight attendants, all that kind of thing. Financing activities would be when they go to the bank and they get cash for like a loan, or when they're paying out dividends, which is distributions of profits to investors. When investors invest in a business, they expect something back. They're entitled to all the profits of a business. How that gets returned is something called dividends or distributions. Could also be called withdrawals or those would be financing activities. Investing would be when Southwest purchases like a new plane, long-term assets. That's and so in that case, and we'll go into, so this is more detailed definitions of what these three are. Financing is investors and creditors, like we said, getting a loan from the bank, paying dividends to investors, getting additional investment from investors. So if Southwest issues more stock, sole proprietorship runs out of money, and then you as the business owner have to put more money into the business, That's a financing activity. That's you putting more funding to get your business going. Um, Investing is purchasing or selling long-term assets, and operating is the general operating business activities, the primary function of the business. Um, Issuing stock for financing and loans, getting loans from the bank. These are going to be especially relevant on your homework to the statement of cash flows. Uh, it's going to say these are all the transactions on the accounting equation, and then when you're splitting them into the actual financial statements, you'll have to classify which cash inflows or outflows go to financing, investing, or operating. And that's how things are displayed on a statement of cash flows for all businesses in financial accounting. So that's why this is relevant. Investing, purchasing, plant, property, equipment, and then operating, the warehousing, the actual cost of warehousing, the cost of building the warehouse would be an investing, but then the use of it is an operating expense. And then salaries, insurance, the day-to-day. So and then does anyone have any questions about operating, investing, financing, how it's used? And if I say if I say something and I trip over my own words, or if something just doesn't make sense, just tell me. Because I'm here to help you guys learn. The role of accounting in business is to provide information for the managers to use, and also for investors, external stakeholders, anybody that interacts with the business and needs to know how financially sound is a business, how much money are they making, and how are they using the funds that they get. That's what accounting is for. It's an information system, really, that just shows you inside what's actually going on in a business. And so that's why learning accounting is so important. Even if you're going into marketing or management, and we're all working in the world of business, or even if you're going into STEM or finance or humanities, we're all like, accounting is a skill and it's a language for how to understand what's going on in a business. And especially learning how to read the 3 financial statements, regardless of what you do after this class, will, I think, be the most valuable thing to take away. Because there's a lot of terms, and it's a whole new language. So, but we're gonna go through it step by step, really simply, and it is fairly easy to understand as we go through this course. Business activities and measuring business activities. So a company's resources are their assets, the amounts that they owe to other people, liabilities, and then an amount that's left over for the owners of the business would be the stockholders' equity, owner's equity. Those are all going to be shown on the balance sheet. Distributions to stockholders are dividends or withdrawals, is what they're sometimes called. And those will be on the statement of owner's equity, and also the statement of cash flows if they're cash distributions to investors. And then sales and costs, those are revenues and expenses. And then after that is net income. Those are shown on the income statement, which shows how profitable a business is, and also the statement of owner's equity, because revenues minus expenses is net income. Net income increases the owner's equity because the business has made money. The owners now have more money. Um, we'll go into more of that later as we get into more of the accounting equation details. This graphic is really small. I think we're just going to skip it. The role of ethics in accounting and business. Accountants are the record keepers of businesses, and it's very important in the accounting profession to have good ethics. You know, we're going to go over some of the times where this is not like where accountants don't behave ethically. And, that means that accounting financial statements are less trustworthy. Really, for accounting to be a trusted source of information and financial statements to be trusted, accounting has to be ethically a good career. And also, auditing and accounting is very involved in creating like internal control systems, which are business processes that make sure that everything is carried out in a proper way. There's segregation of duties, so not more than one person is doing the same thing. Don't be evil, basically. There are many examples of companies not behaving ethically. Most famous example is Enron. If you're interested in a really cool accounting story, book, or movie, the smartest guys in the room is a really good book about one of the auditors that found the fraud in Enron and exposed it. Essentially, they said that they used a lot of really strange accounting techniques and basically made up stuff to say that they were making money on trading utility futures when they weren't. And the whole company blew up, and it ended up in huge stock market losses for investors. Wells Fargo is a more recent one. They're opening accounts for customers without their permission. So you'd go in and open an account and they'd open 3 because the salesperson had to make their quota. And you have all this tone at the top pressure that's creating these incentives. People are forced to basically, in order to survive, the people underneath are forced to do fraud, essentially, opening customer accounts without their permission to make their sales quota, or they're going to get fired. And the people that don't do that get fired. It's not good. It's really not good. And I mean, it hits close to home to me. I worked in the audit world at PwC, a little bit about what that is as a career. I take a look at financial statements of public companies, or at least when I worked on audit teams, you get the financial statements of a public company, and the auditor has to give an opinion on, is this accurate? Like, are these financial statements accurate for investors? And you go through all the accounts and a lot of the underlying evidence and essentially verify that that things are being recorded correctly, and that they do in fact have this many assets and liabilities. They have made this much revenue, expense, and profit this year, and that investors can trust what people are putting out there as investors. And so really trust is one of the most important parts of accounting. We'll go into more of the accounting career path. One of, if not the best reason to study accounting, is the money. And it really is a stable career profession that a lot of people are looking for. This salary information was taken from Robert Half's salary guide uh, in this year, and I do think it's fairly accurate. Um, and these are median salaries, but these are all entry level jobs as well. So uh, bookkeeping, payroll clerk, general accountant, probably 45 to $60,000. I think that's a pretty accurate range. Budget analyst, 69,000. Cost accountant, 76,000. And then um, if you're going to do cost accounting, the CMA exam, that's a very applicable exam to people going into industry. If you're going to work as just a corporate accountant for a manufacturing business, a lot of the management accounting items are good for studying or are good for working with that kind of business. That gets more into next semester's managerial accounting, or the following course is managerial accounting. It's really focused on learning how do you record manufacturing business uh, expenses and allocate that to all the goods that you produce. There's systems for that, right? Because you're using a machine to make thousands and thousands of little toys or widgets or um, brew beer or anything, right? And how do you allocate the expenses to each one? That gets into a lot of management accounting to understand how profitable is the business and all the processes. A little bit of a tangent, but that's what cost accountants do. Um, Internal audit, that's working inside a company, auditing the company. My grandfather was the um, chief of internal audit at Northwest Airlines, which got bought out by Delta. I come from a family of accountants. My mom was an accountant. My grandpa was an accountant. I swore never to be an accountant, and here I am. But it's the life I've chosen. And yeah, so you basically you look into a business. You're working. Sorry, guys. You work auditing internally for a business and making sure that all the controls are correct, no one's stealing money from the business, all the financial reporting is done correctly, and you're more reporting directly to the board and the owners of the business so that you can keep management in check if they're not behaving. IT audit, that's you're more technology focused auditor working on the technical, like the business system. So for example, you're auditing the accounting software that a business uses. For example, Workday, SAP, JDE, these are all accounting systems that companies use to record, or small businesses use QuickBooks. Generally, if that's not a big enough company to have an IT auditor, but that's the kind of thing that IT auditors do is they audit the reports, they audit the financial accounting software to make sure that the IT is working correctly to support the financial accounting, because that's a really important part of trusting the systems that you're using. Generally, they'd be employed by the external auditor, like where I work, PwC, or like Deloitte or KPMG or CLA or things like that. And they would support the the core engagement team auditors that are auditing the financials. Now, public accounting, this is what you generally think of when you think of an accountant. This is the person you go to do your taxes, or tax audit, some consulting, and your work for a public accounting firm, which is why you're called a public accountant, but even though you're employed by a private business, and you do financial accounting or tax accounting for a lot of other businesses. And this is what I do. I have my CPA. There's an exam certification process that goes with that. Generally, I think annual starting salary is about 70 right now. And the upward career trajectory is really great, honestly. If you're working on auditing public companies, you're working during busy season, a lot of hours. but you're also getting to see inside the processes that you wouldn't see if you worked at the business entry level. It would be 10 to 20 years of moving up the corporate ladder before you're looking at the business processes that you're looking at as a first year audit associate. You're getting into the details of the board minutes and reading what is the board thinking about. That's pretty, and then looking at all the revenues of the businesses, the key reports, the transactions that they're running. I maybe went on a little bit too long, but I think it is important to show any of you who are considering a career in accounting, what is the stuff out there like? And if you have any questions about this, you can talk to me, after class, during office hours, whatever, and pick my brain on what a career in accounting is like. I would love to give some of my stories. I'll try to give them throughout the class as well, but um, does anybody have any questions on the accounting career path? You look like you have a question. Cool. So generally accepted accounting principles, also known as GAAP. This is created by the Financial Accounting Oversight Board, or the FASB, which is Financial Accounting Standards Board. And they determine all the accounting standards. And they have a list. You can look them up. If you can't sleep at night, you can just start reading the FASBs. And you can, they're the assumptions in the framework that underlie financial accounting. And yeah, so we'll be using all their rules. It keeps everything standard for businesses. Internationally, they use IFRS. They're so similar. There's just some minor differences between US and non-US accounting standards. The rules of financial accounting. Investors and creditors and external parties to the business make their decisions based on the reports that we generate as financial accountants. And they're standardized using GAAP. The FASB is governed by the SEC, which is what oversees the stock market. The SEC was created basically in response to the stock market crash during the Great Depression to make sure that accounting standards were standardized so investors could actually know what they're looking at when they're looking at a business. And they require businesses to have financial statements, especially they govern public companies, but they require all public companies to publish financial statements. We can go over a few of them when we start going over the financial statements as individually. Yeah. They require quarterly financial statements from public companies, and they govern all the rules related to financial accounting standards and also auditing standards. So we can go over a number of businesses and determine whether they're what type of business they are. Aloka is an aluminum manufacturing company, so they're manufacturing. Boeing, what would Boeing be? Yep. Caterpillar. Yep. Citigroup. Yep. CVS. Dollar General. ExxonMobil. Yep. That'd be manufacturing. Getting raw oil and then turning it into gasoline and things like that. FedEx, Ford, Gap, yep. H&R Block, Hilton, Procter and Gamble, and then Southwest, and we got Walmart. Great. You guys are pros at this. Um, More about Gap. I feel like we already talked about all of this stuff. Um, the SEC mandates Gap. The FASB develops Gap. That's the relationship between the two. The underlying assumptions, this is important stuff. The economic entity. So Gap, you have to assume something about a business that you're looking at as an accountant when you're applying Gap to the business to create financial statements. One is an economic entity. You have to define what is the business you're working with, and when there is a transaction, you record the transaction as to how it relates to that business. So if you have a personal business, that sole proprietorship, which is a personal business, is the entity. If you are spending personal expenses, you can't record that in the business. If you have multiple businesses, you have to separate them unless you're looking at a consolidation of all of them. So it just defines what are you working with, the scope of the units. Monetary unit, in the US, it's US dollars. And that just is a standard currency. Period. How long are you looking? So, for example, is this a quarterly financial statement or a annual financial statement? Revenues and expenses happen over a period of time. You need to know what time period you're looking at. Going concern, this is, we have to assume, hey,
I just look at.
I think that was John Gallup. He's one of the legal professors here. And he was my legal professor when I was here. And he is awesome. I highly recommend his classes. Going concern, you have to assume that the business is going to exist for more than a year in the future. And this is important for financial accounting consideration, because if a company is going to go broke within a year, they're going to have to sell all their stuff, and it's not worth as much. So if you buy a whole building to build a factory, and you build a factory, you have to assume that it's going to provide you value, and you're going to be able to use it many years in the future. Because if you're going broke and have to sell the factory, you're probably only going to get a fraction of the value of it. And that's why going concern is important. I have seen companies that have a going concern label on their financial statements. It triggers a different accounting treatment. And that's because if they don't get more money from investors this year, they will go broke. So that's that's the story behind that. It can be particularly contentious with auditors if a company is sort of on the edge of that. They don't want that label on the financial statements. The management does not want that label on the financials, because then it's going to cascade the situation and be worse. But as accountants, we have to be ethical and apply the facts as necessary. So financial reports are relevant and faithful representations, and this allows stakeholders to look at financials and make sure that they can trust what they're looking at and that the information is actually useful to them. Their comparability, so different businesses all have the same things classified to each expense category. The financials are all structured in the same way so that when investment analysts are looking at different companies or banking loan people are looking at businesses, they can compare them. Verifiability. This allows, it's more on the trust. You have to be able to trust what you're looking at. And that goes into like, is this auditable? Timeliness and understandability. Timeliness, that's important. If you're getting the financial statements from over a year ago, that's not nearly as relevant as if it was sooner. And so the SEC does mandate for public companies, there's a period of time that they have to file their financial statements. There's penalties involved, and that's sort of how they enforce that. Same with taxes. You have to file your taxes by April 15th, right? So we already sort of went over this on the previous slide, but monetary unit, time period, they're very important to make things standard between businesses and to make sure that you're defining the scope of the transactions that you're going to actually be working with, the perspective of the transactions, because say there's a sales transaction, are you the buyer or are you the seller? It could be inventory, it could be revenue for you. Depends on what business entity you're using, time period, revenues and expenses, dividends, it all happens over a certain period of time. The accounting period adopted by a company is the fiscal year. So a natural business year is when it ends at the lowest point of an operating cycle. I worked on some manufacturing clients, and some so agriculture is that was the most relevant one to this concept of a natural business year. Basically, to make the auditing easier and the accounting easier, they set their fiscal year as of August 31st, because that was the point at which they sell a whole bunch of supplies to farmers, and then they buy the grain from the farmers. And that was the point at which they had sold everything, but the harvest had not yet happened. And so it made the accounting a lot easier to have their fiscal year on August 31st. And I thought that was, that it makes sense, right? Then it reduces the cost and effort associated with accounting. So that can be why you put your fiscal year on a different time period. Anoka Ramsey's fiscal year is 6/30, and that's to align with the state of Minnesota. And also, it makes sense for a college because there's not a lot going on during the summer. The state of Minnesota has it in the summer. I think it has to do with the legislative session. Businesses will pick their fiscal year based on what makes sense for making accounting easiest and least costly for the business, and also making sure that the information is relevant to the users that are actually going to be using it. We talked about business entity, we talked about going concern. Does anyone have any questions about these assumptions? Great. Types of businesses. Sole proprietorship is the most common type of business. It's the easiest to start, and it is if you start a business yourself and you don't even have to regardless of whether you file paperwork with the government or not, if you start your own business and you are the only person that owns that business, it is a sole proprietorship. That's the definition of it. It is a business owned by one person, regardless of whether the business is registered or not. It is a business. Does that make sense? It's all this sort of legal stuff is made up in a sense, but a business is something organized for profit, whether it's written down on paper or not. And a sole proprietorship, if it's owned by one person, a partnership, if it's owned by two or more people, it's slightly less common because it's more people. Partnerships also can be registered or unregistered, right? If you and your buddy start a business, then it's a partnership. It doesn't matter whether you registered it or not. I recommend registering it, but I don't know. A corporation is a more specific type of business, and that means it's organized under state and federal statutes. It's a separate taxable entity, and these are really useful so they generate 90% of business revenues, and that's because it's the easiest kind to make into a giant company and to separate using shares of stock and be able to trade the stocks. And it separates the ownership. If you have a sole proprietorship or a partnership, this all goes onto your own personal taxes. A corporation is a separate entity, and then if it pays you dividends, that would go on your taxes. That's sort of the distinction there, and that's why a lot of these giant companies, that's why they're essentially all large businesses. And then an LLC is a cheap way to register and separate the legal liability of yourself from your business while still being small. Generally, an LLC is a separate type of business entity, and then the taxation can be as a sole proprietorship, a partnership, or a corporation. It sort of depends on what you elect. It sort of depends on the other ways that you organize the business, and that's sort of beyond the scope of this course. But any questions on business entities? Great. So the principles these are the principles that underlie GAAP, and they're super important. The measurement principle is the amount that's actually going to be recorded and reported. So if you are buying, for example, historical cost of large fixed assets. If you buy a factory, that factory gets reported, if you buy a car for your business, it's not an expense this year. It's recorded as an asset at historical cost. So say you buy a car for $20,000, that goes on your books at its historical cost, $20,000, and gets slowly depreciated over a certain amount of years. Now, the certain amount of years, the historical cost, that would all be part of measuring and the measurement principle. Arm's length transactions provide amounts that are objective and verifiable. This gets more into financial assets. For example, if a bank is holding on to a large portfolio of loans or bonds or things like that aren't traded too often between people, so you don't know how much they're worth, you have to look at similar sales of bonds by similar parties, and those would be arm's length transactions. You can use those to value your financial assets at fair value compared to historical cost, what you paid for it. Oh, there we go. Revenue is the amount earned or received from selling goods or services. Revenue recognition and expense recognition. These principles essentially mean that you have to record the revenues and expenses in the period that they're earned. And that's also related to depreciation and historical costs that I was talking about earlier. The revenue, and also related to the whole Xbox Live example that I was using earlier. The revenue has to be recorded in the period which you actually earn it, which you're providing the service, which you actually deliver the goods. That's when you get to record that revenue, and then you have to record the expense with the matching principal, which is at the same time as the revenue associated with that expense. So, jumping onto the Microsoft example, if Microsoft has a contract with a data center and they prepay that a year in advance, that's not an expense all up front. That expense gets matched to the revenue every quarter. So in the first quarter, they get the revenue that they earned from their first quarter contract, and then the expense from the first quarter contract. And then say that, this is also very relevant in inventory. If you have a business, a retail business, you purchase a whole bunch of inventory. That's not an expense when you purchase the inventory. That expense, cost of goods sold, goes on your income statement the period which you sell the inventory. So
say you buy $100,000 worth of inventory and the first quarter you sell 20,000 worth of that inventory, that would be all you would record in that first quarter, not the 100,000 that you bought.
Exactly. And the 80,000 would remain as an asset on your balance sheet as $80,000 of inventory, because that's something that's going to provide you value in the future. It's an asset. And then it's the same, deal too. If you purchase all that inventory in the first quarter, you sell $20,000 of that inventory for $30,000, you don't get to record that revenue until it gets like shipped or delivered as you have agreed with the customer. So we're going to be grouping these with the business entities that should record these transactions. Linda bought lunch for her book club. So Linda has the Lake Boutique. Eric and Linda have a savings account with their children, and Eric owns Ozark Sports. And then Missouri State Bank is a bank that's separate to these two characters. So Linda bought lunch for her weekly book club. Is this a business expense? No, great, it's not. Linda purchased 24 spring dresses from a designer for a special sale for her boutique. I would think that's a business expense, right? So that would be the Lake Boutique. Eric paid a breeder's fee for a dog. That would be the Ozark business, right? So this is just showing we need to classify each of these transactions to the business entity that we're talking about. Eric paid a doctor for the physical, which was required by workers' comp. That would this be personal or business? I think it would be I would think it'd be personal. Yeah. Hmm. The business is paying for it, right? Yeah. That's the key. The business insurance policy required it. Eric received cash advance for a guided hunting trip. That'd be Ozark. Linda paid her dues to the YWCA. Probably personal. The donation from inventory. See, accounting, a lot of it's really key word problems, and having words in there like inventory or just seeing what it's about figuring out what is the question asking of you. And in that case, it would be a business. Eric paid for dinner for the wedding anniversary. Happy them. Personal. And then add in the Hunter's magazine. That'd be for business. The accounting equation is assets equals liabilities plus stockholders' equity. This is the relationship between these three things, and it's pretty natural, right? You have your assets, which are things that are going to provide value to you in the future. Liabilities are things that you're going to owe to other people in the future. Stockholders' equity then is what you have left over as a business. Most of the homework is going to be separating, transactions out between the three of these on very large tabular homework exercises. I don't, and uh, and showing the effect of a transaction on these three items. And from this, we get basically how we record all of financial accounting. Assets are resources. Liabilities and stockholders' equity are claims to resources, whether they're from creditors or whether they're from owners of the business. So give us an example of what a company would have as an asset and a liability, and consider what an individual would have as an asset and liability. So how would an asset differ from a business compared to an individual? Personally, I think an individual can calculate their net worth using the same accounting equation as a business. If you have your assets that will provide you value in the future and your liabilities, things that you owe, you can calculate your net worth. It does get complicated in certain things, though. It's like, what do you actually record as an asset? Is your education an asset? Your student loans are a liability, but is your education an asset? I mean, your education is an asset, but if you're calculating your net worth, are you thinking about the same things? So that's why it's important that we have GAAP and we can know what is an asset, what is a liability, what's actually in scope that we can record, and what do we not record. The accounting equation. So determine for each of these, what is the stockholders' equity? Anybody have a calculator? What is the equity of Kroger? Or yep. And assets minus liabilities, stockholders' equity. And then Procter and Gamble would be about, yep. And so we can determine using the accounting equation what is the missing amount here. And this, this is helpful when filling out your homework. If there's a value that you don't know or that the homework doesn't tell you, you can fill in the blanks. So assets is going to equal liabilities plus owner's equity. You can fill in the amounts. And this also works for, right, if you have a complete balance sheet, complete incomes, or if you have a complete, if you've on the balance sheet, if you've completed the assets and the owner's equity portion, but you're not done with the liabilities section, and there's only one account that you haven't done yet, and you know what the total liabilities are, you know what the rest of the liabilities are, you can know what the remaining value is. So it can help you plug it all in as sort of a logic puzzle game. And This does happen in actual accounting too, plugging the numbers. So a business transaction is an economic event that changes the condition of the business. Um, Generally, it's purchasing something with cash, getting cash for something, or it could be accruing something at the end of the month. For example, the unearned revenue that you get for a service transaction that lasts a whole year, you accrue it at the end of each month, that kind of thing. But it it's a transaction that changes something on the financial statements of the business. It has to be recorded. Transaction A, uh, Chris deposits $25,000 into the bank account of Net Solutions. So Net Solutions is the business entity, and that's going to increase assets and increase owner's equity by the same amount. And as you can see, we have transaction A, and then the little A just indicates that it's transaction A. So when you're looking at a transaction, consider what's one account that this impacts, and does it go up or down? So cash goes up, and then okay, what is another account that's affected? Owner's equity. And notice how they're both on the opposite sides of the accounting equation, so it remains in balance. It has to remain in balance. And if it is not balanced, something is wrong. The purchase of land changes the makeup of assets, but it does not change the total assets. For example, Net Solutions is paying $20,000 for land for the business. Their cash goes down by $20,000. Land, another asset, goes up. The equation remains imbalanced because you still have $25,000 in assets, $25,000 in equity. If you purchase supplies and agree to pay the supplier in the future, this creates what's called an accounts payable, which just means it's a bill. It's something that you're going to owe in the future. This can also be abbreviated as AP. And a supply is something that the business is going to use in the future, especially like the immediate future, and that's called a prepaid expense. Other prepaid expenses can be something like the prepaid software, prepaid insurance, prepaid rent. It's something that you're paying that's going to be useful to you beyond the current business period, whether it's the month, whether it's the year, something that you haven't used yet. You haven't used the supplies yet right when you buy them. So what's one account that this is going to impact, this transaction? Yes, but supplies, exactly. So Net Solutions is the business entity, but the account would be supplies. And then, which is an asset. And then what's another account that would be affected? Um, so there's actually no cash involved in this transaction because they haven't, that's what the on account means. So on account means that they're going to pay for it later, or that if it's a revenue transaction, that they're going to get paid later. So it would be accounts payable would be the other account, and that's a liability. And but that's a really good point though, because when looking at these word problems, there's key words like on account that means that this is a credit transaction. They're not paying up front. And since this is the business buying the supplies asset is going to go up, and accounts payable, a liability, is also going to go up. And so our whole equation remains in balance. So Net Solutions receives $7,500 in cash. That's going to increase assets of cash by $7,500. And then fees earned is a revenue account, but revenue and expenses are owner's equity accounts because a revenue is going to increase owner's equity because the business owner is getting more money. An expense is going to decrease owner's equity because it costs the owner's money to pay for things. So our equation remains in balance. Other examples of revenue is fees, sales, rent revenue, interest revenue. These all increase the owner's equity. And it's irrelevant whether or not they received cash. So if it says they sold inventory on account, that would mean that they get a accounts receivable. So we had accounts payable, that's what they owe. Accounts receivable is bills that they are owed, that they need to collect from a customer. And that's an asset in the current asset section because it's going to be collected within a year. And we'll go into a lot more detail on accounts receivable in later chapters. Particularly in the retail chapter, which I think is chapter 4. Net solutions paid the following expenses during the month: wages, rent, utilities, and miscellaneous. As we talked about, expenses reduce owner's equity, and they're all going to be recorded in separate boxes, like separate accounts, right? Because we need to record what happens in the business in like a granular enough way that we can look and analyze what are the expenses, but also not be too detailed that each transaction has an expense. These will be the accounts that you'll see. The homework essentially is this. It's getting sentences and word problems. Oh, we're at time. Okay. Great. Yeah. So this is a lot of what the homework will be like. It's just taking a look at the accounting equation examples and classifying them to their accounts and things like that.